So, is infinite banking gonna make you rich? Oh no, was that title just clickbait? Because here's the reality, guys. Infinite banking will not make you rich, but I guarantee it will get you there faster by paying you twice for your investments. So let me show you how that really works. Okay, so let me come back to this, the whole clickbaity thing, right? Because in reality, infinite banking will not make you rich. Now, you can grow your money well. It's a great, what I refer to as a supercharged tax-free savings account where you use your whole life policy to grow tax-free at like a good 5% plus tax-free return. Let's just admit this. And I know a lot of infinite banking people out there would get mad at me for saying this, but 5% a year is not much, okay? Like that's not gonna get you rich ever. I mean, you gotta pack a lot of money in for that to really build a lot of cash. And so 5% a year is not gonna be enough. Even if it goes up to 6, 7% a year, it doesn't really matter as much. It's the same reason that I say you can never really get rich just putting money in mutual funds. It just doesn't work that way. But here's how it can actually help you build wealth faster, okay? It's because you're not just using the infinite banking policy. Yes, it's a great place to store cash. Yes, I can keep my emergency reserves in there like I keep a big bulk of my reserves actually inside my infinite banking policy versus keeping it in the bank earning 0.nothing%. But what it actually does allow me to do is invest that money to earn money in two places at the same time. So let's go deeper into that, what that really means. Now, when you start to build up cash, now remember, whole life insurance, which is what infinite banking is based on, not universal life or any of that kind of stuff. This is not just death benefit. This is not just like term insurance where you have to die to get paid. This one actually allows you to have the death benefit, but it also has this tax-free savings account inside of here. So it has money in two places. This is why it's more expensive because you're essentially, it's kind of like buying term and investing difference, but you're just doing it all at once. Now, some people will critique it and say, no, that's a horrible way to do it. And they're right. Because if you buy the traditional whole life insurance that you buy from your State Farm agent, you know, Jake at State Farm with his khaki pants and all that kind of stuff, it's not gonna work, okay? It's just not gonna do well for you. And even 99% of the time, if you go to insurance agents, there'll be insurance costs that you're paying too much for. You wanna make sure it's the max benefit possible by getting those costs as low as you possibly can while putting the money in. This allows your cash to grow more quickly inside of there, and that allows you to be able to use that money. And you can use it for whatever you want. So there's no restrictions, there's no dumb 59 and a half age penalty where you get charged 10% for early withdrawal before 59 and a half. You can access this money in the first year. There's no dumb rules about how much you can really put in, although there are some limits there. But for the most part, people can pay in probably more than what they can afford to pay into it based on how we design it in our own company at Money Ripples here. So there's a lot of different things you can do that just give you flexibility to be able to use this and save rather than just putting it to your bank account and then invest it. And here's the key thing. See, when you save money up normally and put it into your bank account, you build it up, and then when it gets to a certain point, you say, great, now I have enough money to invest, and you take that money and invest it. So now your money's making money in that one investment. But the money in the savings account, you're not earning interest in that anymore, are you? Because you just withdrew all the money and invested it. Now your account balance goes down to about zero. So now you're earning nothing on, well, you weren't earning that much anyways with the interest in the bank, but now you're earning nothing on nothing, right? You're earning point nothing on nothing. And so you have to slowly take the cash flow from that investment and the returns from that and use that to build up your savings account. So then you can take that money and invest it again, right? But with infinite banking, when you use the life insurance and you use it the right way, what you can actually do is this. You still store it up like you're doing with your savings account, but what you do is you, instead of just withdrawing the money, which is an option, instead what you do is you actually take a line of credit. You borrow the money. And now you don't just borrow, like pull the money out. The money stays there. So your money's still in there. So let's say you built it up to $100,000, right? You have that $100,000 that's in there. It's in there earning tax-free interest. Now, that money you can actually not just pull out, which is an option, but instead you get a line of credit from the insurance company. You get the money from them. Why would they give you a line of credit and not even require you to make monthly payments? Because they know you can make more money on the money that's sitting inside that policy than what you're paying them in interest. So they can let that loan go forever. In fact, the deadline for paying that loan back is your death, and they just pay that back to you tax-free. So what you're doing, you're taking that money, using that to invest. You're getting the money from them, investing that. So your money, the $100,000 is still in there earning tax-free returns, and at the same time, you're also earning money in that investment. So you earn the money there and here, earning money in two places at the same time. So what that does is that it's not just cool so you can go and invest your money in real estate and things like that, which I love, because I love investing in cash flowing investments that pay me money. But what's even better is I can earn more money by using the money from my policy. I use an example for a lot of my real estate investor friends. I said, hey guys, let's just pretend you're buying $1 million apartment building, like a small apartment building for $1 million. And say that the down payment on that is 25% or $250,000. So they take $250,000 that they would use in cash from their savings account and invest it. Well, if that investment property made them $2,500 a month or 1% a month on their cash on cash return, right? If that money's making them $2,500 a month, they would take that, put that back in their savings account. So over 9 years, that's $30,000 a year, they would be paying back a total of $270,000. But if you put that into a 0.1% savings account with your bank, and you have to pay taxes on that money too, guess how much actual net return you make? You make just over $1,200 in 9 years in interest. That's all you make. That's it. But using that same strategy, using the life insurance, I use my own policy as an example, that same exact strategy, guess what? I would earn, instead of $1,200 a year, $1,200 over 9 years, I would actually earn $128,000 over 9 years using my life insurance. Why? Because it makes a heck of a lot more money than 0.1%. That's why. That's the big reason why. So you're getting that compounding effect working for you, even though you're paying interest to a bank. And just so you know, you're not paying interest to yourself, right? That's one of those half-truths that they always teach you out there in the infinite banking world that drives me nuts. No, you're paying interest to this insurance company or to a bank like they're a bank, right? You're making the money off that. But the big key difference is that money is also growing faster in what they're paying you versus what you're paying for that money. That's how you're able to get your money paying you two places at the same time. And the great thing is that not only is it just allowing you to make you rich, I mean, it can actually help you get rich in other ways. So for example, I had a client who used this policy that went and used it as collateral for getting a bank loan on a building, on an office building. So he got that office building there. He was using that money to go put the down, really just to buy the building in cash, right? But he was using the bank's money still. So the bank said, hey, you've got cash in this insurance policy and you have a building. We'll give you a 2% reduction on your mortgage rate. So he got this dirt cheap rate on his mortgage, giving a really cheap payment. He built out the building. He started renting out different units. So the other renters were paying for his mortgage payment. And then guess what? A year and a half later, he goes back to the bank. He says, listen, you gave me a great mortgage deal. Can I take that lien off of my life insurance? Can I take that off? And now that we have a building as collateral. They said yes, and we'll keep the terms the same. So he was able to have this still dirt cheap mortgage payment that he would never have gotten had he not used the life insurance as collateral first. He was able to keep those great terms that he would never have gotten. So that's one way you can use it. Another way to get rich, Walt Disney did that. He actually used the money as a down payment for the swampland called Orlando, right? Or Celebration, or whatever part of Florida you want to talk about. But basically for the property he bought for Disney World, he had to come out of pocket with his own money. The banks wouldn't come and lend him the rest of the money unless he did. So he used the cash from his life insurance policy as collateral so the banks would come in with the rest of the money, and the rest is history. He also did this with McDonald's. Did you know that McDonald's, like Ray Kroc, when he bought it from the McDonald's brothers, he actually used his insurance policy to keep paying those executives so they would stay on board and keep McDonald's growing the way it was. Pampered Chef. Have you ever heard of Pampered Chef? That was the seed money that she used from her insurance policy to start Pampered Chef to make it into a massive business. And so, and of course the list goes on and on. This is not the first time this has been done. This has been used for years, yet we haven't been taught about this, right? We haven't had this kind of experience because the truth is insurance agents don't want to teach you how to use it the right way because they cost them money if they teach you this. And then two, financial advisors think it's a crock anyways, and they don't even get taught how to do it because insurance companies don't want you to know how to do this stuff. Insurance companies make more money by you just buying the same old crappy term insurance for the rest of your life where they never pay out. Why? Because you'll cancel your term insurance before you die. And insurance companies make the most profit off of term insurance companies. Is it no wonder that people like Dave Ramsey out there will say, buy more term insurance? Because the insurance companies are the one that tell him to teach you that. That's why. And I'm sure they sponsor his shows and things like that when he says, well, go talk to this term insurance company to do that. That's a whole nother topic right there. The point is, you can use this money to pay you twice and build generational wealth for you and your family. Because not only can it be used to build wealth and be able to invest in business or in real estate, but most importantly, guys, you still have that tax-free death benefit that can come through. You can get policies on multiple members of your family, pays into your family trust. And then that family trust grows and builds over time so that your generations of wealth grows rather than shrinks like most people does. So guys, I hope that was valuable for you. I hope you learned a lot. If you like this, just keep checking out more in this series of Make You Rich.